Why, hello there, and welcome to another episode of the Innovantage Podcast, where business meets tech to bring you your competitive edge. As always, I am your host, Max, and it is my job to find that edge between business and tech. And to help me on that journey today is Mr. Mike Sigal. Mike is the venture partner at GPO Found and MiddleGame Ventures, member of the investment committee at SC Ventures, and a renowned startup mentor with decades of experience in the sphere. So, hi, Mike. Welcome to the show.
Hey there. Thanks for having me.
Can you tell us a little bit about your journey? How did your life take you to the point where you are today?
Yeah, absolutely. Happy to. I have been in and around the tech industry for my entire life. I grew up with a father who was an AI engineer before it was really called AI engineering in the defense industry in Los Angeles. Worked on satellites and missiles and airplanes and things like this. I went to school at University of California at Berkeley, originally starting out in computer science, but I wasn't smart enough. Ended up going in economics. Um, in the late '80s, and before I had graduated, I had started my first business with one of my schoolmates, which then became, it started off as a clip art company and then became a gaming company. The assets of that company later became something called Blizzard Entertainment.
Oh, wow.
The first versions of the game that became Diablo was coded in our sort of back alley office. So I've been around tech for a very long time. That experience really showed me that I loved the process of entrepreneurship. So that was the first of seven, or if you count a not-for-profit that I worked on, eight startups that I was founder or co-founder of across, well, graphic arts and clip art, early cloud databases, analyst firms, software firms, fintech, including the not-for-profit. Um, had some successes, some failures, raised venture capital a couple of times, had a number of exits. One company that I had founded, I then sold and was a senior executive before the year 2000. I was a senior executive through that company's IPO. So I've sort of been through the entire startup to exit journey multiple times. And I always really sort of enjoyed the process of, um, you know, finding a problem, gathering up a group of people to solve the problem, and trying to create a solution to that problem. Sort of between my startups, I often, whether through an acquisition or because the startup failed and I was sort of kicking around consulting and trying to learn about, what else there might be in the world that interested me, would often end up doing consulting for mid to large size corporations. That landed me in, when was it? About 2010,
Mm.
2011, beginning to work with Swift, the global payments network, helping them to try and bridge the gap between startups and their member banks. This was before the term Fintech. I ended up helping them create a competition that was designed to create relationships between startups and their member banks. And through that competition, we introduced their banks to companies like Wise.com and Revolut and Currency Cloud and a lot of sort of the fintech unicorns. And that sort of inspired me around the fintech space. And I started working on what at the time would have been my seventh commercial startup
Mhm.
in fintech. I went to a buddy of mine who was the founder of 500 Startups and said, hey, I've got this idea. I'd really love to use some of your portfolio companies as a beta test group. And he said, well, I've got this new partner that's working on a fintech fund. If you can convince him to to be interested in what you're working on, then sure, you're welcome to. And from one sort of Thursday to the next Monday, I went from having met the guy, realized that the guy had been part of the competition that I built for Swift. He invited me to be his entrepreneur in residence to help him build 500 Startups' first vertical fund, which was the Fintech fund. And that's sort of what bridged me into venture capital. And so I then went on this journey, as fintech grew, so did, sort of my experience in the fintech space grew. Then come 2019, we had deployed over 88 first investment checks into companies in 26 countries.
Oh,
And I
wow.
realized I don't really like being a VC. What I really love it now at this point in my life, that's 2019, is working with the entrepreneurs. I also don't really mind, and I kind of enjoy sort of the strategy part of being a VC, but I don't really like the administration. And so then I reframed myself into who you see in front of you today, which is someone that has moved from sort of player to coach, and now I spend my time as a coach and as an advisor to both founders and fund managers, and when I say fund managers, that often includes corporate venture funds like Standard Chartered Bank's corporate fund SC Ventures, where I sit on the investment committee. So I have some non-exec roles, and I really enjoy it. So yeah, that's kind of been the journey. Is my own learning as the industry has evolved.
That's a huge amount of expertise. That's just. How do you balance it all? So you've did manage to find something that you are actually passionate about throughout all of your journey. It's something that many people and many entrepreneurs specifically, I feel, are struggling with. As an entrepreneur, you don't really have the time often to actually think about, do you enjoy the things that you do? You just get next milestone, next step, next venture fund, next funding round, next release, next, and then you don't really have the time to take stock and understand what it is that you're doing. So what's your secret been to that sort of self-reflection? How did you arrive to the point that, yeah, you know what? This is what drives me. This is what I actually like.
Well, look, it's changed over time, and it's been phases of, oh my God, I hate my life, and well, what is it that I enjoy? There was already sort of an inkling, if you will, when we had COVID lockdown, right? I already sort of knew that being a VC in 2019 wasn't my great love, but working with founders was. And then COVID happened, and a lot of what the trappings of being a VC, or the way that I styled myself, went away. And when I say styled myself, it's, we had a global mandate, and I already was working with a lot of corporates that I had created relationships with while I was working with Swift. So I sort of was flying around the world, maybe traveling 60% time, and I would go do a keynote speech at a conference, and then I would talk to some potential investors, then I would meet a bunch of entrepreneurs, and I would consider making some investments, and I would learn the local ecosystem. And so, when COVID lockdown happened, all of that part of my job sort of went away. And that sort of forced me to reflect, well, what parts of the job did I really love, and which parts of the job did I not love at that point in my life? And And I realized, well, okay, so then for the next 10 years, 20 years, whatever it is, what I want to spend my time and energy on is taking the last 30 years of experience and give it away to try and help others, be they founders or investors, do what they do better. Because fundamental belief for me is that entrepreneurship is like a force for good. So if I can have an impact on entrepreneurs around the world that makes them perform better, that's very emotionally satisfying for me. So that chance to step away, that break that COVID gave us all, if you will, um, allowed me to sort of restyle. Well, what do I want to do with the next phase of my life? I'd say for the context of the question that you asked was, if you're an entrepreneur or you're an investor and you're deep in whatever it is you're doing, you just have to remember that, okay, well, if I'm a VC, right, or if I'm thinking about going into VC, what does the career path of a successful VC look like? Well, at minimum, that's a 10-year journey. And for good VCs, that's a 30-year journey. So do I like it enough, right? Because, well, think about it. A single fund lasts 7 to 10 years. And it usually takes a couple of years to get a fund off the ground. So that's a considerable chunk of life. Do I love it enough to want to spend my time doing that? Same thing if I'm doing a startup, right? In the classic venture-backed startup world, that takes 7 to 10 years, right, to get to liquidity, which means that as a founder, unless you already know you're the kind of founder that starts things, then brings in professional managers to run it and goes on to do the next thing, that's another commit, right? You're there to change an industry. You're there to commit to that timeline that we don't have any control over. So you got to kind of think about, how do I want to spend not the next quarter or the next year, but maybe in our land, 10-year chunks of time. And then everything within that, the day-to-day, the way that I deal with it is I take joy out of the learning that I'm doing every day and the teaching that I'm doing every day. And that's in the giant context of, well, for this 10 to 20 years of my life, I want to spend my time taking what's up here and sharing it with as many people as I can, which is why I do podcasts like this and why I do coaching and why I'm trying to build coaching programs where I can do more one-to-many than one-to-one and things like this, right? Because I want to have more reach. So, right. So what's tactical, what's strategic? Yeah. Does that make
Thank
any
you.
sense?
Yeah, a lot of it. A lot of it. Though unfortunately not easily applied. Very simple thought, but not easily applied to your own situation where, again, coming back to myself as an entrepreneur, do I know 100% where I'm the best at? What can I do to make the most of my own contributions at this particular time? I may be like 50% there. And I'm guessing other people are at different percentages. But from what you're describing, the journey itself is already eye-opening, so to speak. You got to go through with it. And with every singular one that you take, you become more and more attuned to what is it that makes you great and what is it that makes you excel. And then every singular venture that you move on to, the next one becomes that much more efficient, I guess.
Well, I think you bring up a really interesting point, and this is something I tell a lot of the entrepreneurs that I coach, something that I've had to develop for myself, although sometimes I do it more, sometimes I do it less, right? Which is, right, and I don't want this to sound trite, but all right, there's my journal.
Okay.
Okay.
Very, very authentic.
I bought, this was a gift to myself this is a new one. I bought it, right? It's very fresh and whatever. But it's like, all right, I want a leather journal that's going to like age and grow character the way that I do. But no. To that point, it's kind of like when you think about yourself, when your listeners think about themselves, a discipline where you daily, weekly, monthly, on whatever basis you want, asking yourself the questions that you just posed, right? You said, well, I think I'm about 50% there. Well, 50% to where? Have you written it down anywhere? Wherever you think there is. What is it that you're working on to learn? When will you know, when that you feel good about it? What new questions have come up as you're learning? It's the same. It's almost kind of the same thing as doing customer development. When you're trying to discover a product, except the product is you, right? You go out in the world and you have conversations with customers and you talk to them about what their day is like, and that leads you to new questions. And if you do a good job of writing them down, you come up with these and reflecting on them and digging a little deeper on them and then doing more study on them, you come up with these amazing realizations about where value lies. And I think, doing that inwardly, doing that, helping coach your team members to do that is an enormous source of both power and confidence in developing your career. So reflect a little bit, take a little bit of time, right? When you said you just spent the holidays, you and your wife, you went to the spa,
Yeah.
and which is great. I'm just totally jealous. One of the things, that I try and make now a daily discipline with this, and mercifully, I have a wonderful executive assistant who's helping me with this when we're talking about professional stuff, is, okay, what are the things that I ran into this week that over the next, weeks, months, years, I want to double click on and learn more about? And sometimes that learning leads me to some new insight that I want to share, or some new insight that I want to commercialize, or some new, or maybe it's just an observation, right? But if you're not controlling your own personal and your own career development, well, then who is?
Yeah. Yeah. See, that's, I think, what constitutes a good founder or a good entrepreneur, generally speaking. That ability to self reflect and to ask those kinds of questions and to get answers to those kinds of questions in the end. Because that's kind of the process of asking yourself a question, finding the answer to that question, moving on to the next one, to the next one, to the next one, to the next one. And if you don't, then you're just stuck in a position. It can be a good position or a bad one, but you're stuck there and you're unable to move, and you're unable even to understand where and why would you want to move if you did.
I think there's something to that. I also think, that there's an additional element to that, which is, you need to recognize that, particularly if you are the founder who's going to become the CEO, right? So it's not only you have the idea, but you're trying to create an enterprise that grows to serve other people. Is you have to remember that your number one job becomes cultivating that kind of coaching in others.
Indeed. Indeed. I agree with you completely here. The more your infrastructure grows, the more your team becomes, the bigger it becomes, the more kind of you have to interact with it, coach them, like you said. So maybe let's then talk about, from your experience and perspective, what does make a great founder? What kind of founders do found the next Blizzard, or, who will interact with the next Revolut or Wise, or what will be the kind of the next unicorn, so to speak? How do you spot them? How do you notice them? Is it even possible to do, in your opinion?
Well, I was looking at the questions that you sent me, and I think you're touching on something that we discussed when you and I first talked about, which was a presentation that I put together not too long ago, which was my first sort of presentation that I put together as an interactive exercise using some AI tools, which is about spotting unicorn founders at an early stage. And so I'd rather sort of talk a little bit about the process of that, and then maybe share with you and your listeners or watchers access to that presentation so that they can see it for themselves, because there's a lot of detail in that presentation that the AI tools I used brought me.
Sounds like a
And
great deal.
they'd want to, it's fair to let them double click for themselves. So, basically I'd never really thought in a disciplined fashion about what makes for a unicorn founder, even while I was a VC. And so it was really fun to be given this challenge to, hey, would you do this talk? And it was like in a couple of days. And so I went to ChatGPT and I said, all right, well, I don't want you to, I want you, I had learned a little bit about prompting, and I said, I want you to focus in only on writing by VCs who have a long track record of investing in unicorn founders. And I really sort of tried to look at 4 questions, and this sort of came through the conversation that I had with the AI. It was a really interesting exercise. But I said, so what traits is it that VCs look for, and why do those traits matter? That was the first question. And then I said, what traits does research suggest make the biggest difference in entrepreneurial success? And then I said, what are the behavioral or psychological traits that you can spot in early stage founders who, maybe they've just gotten out of school, or they've just switched from a corporate job, or this kind of thing. And what are the tools that you can use to spot those behavioral or psychological traits? And then just for fun, I sort of asked, well, what are the red flags? So if you look at the first question, the traits that the VCs look for, they, depending on who you're looking for, it sort of breaks down to 5 top things. One is visionary leadership, which is, do you see some version of the future, and are you able to convince others of that potential future? And the AI was kind of fun in that it suggested individuals who were archetypes of these kinds of leaders. And so a visionary leader is someone like an Elon Musk or a Steve Jobs, right?
Sure.
And then the next group of skills were exceptional execution, who can take a vision and push it into reality. And for that, it suggested Jeff Bezos is a great example. Then resilience and grit, right? The fortitude to persevere through setbacks. And it suggested Brian Chesky of Airbnb is a great example. It's a deep market insight and domain expertise in a field, which is, I think, to me, really important when you're talking about disrupting an existing a field. And it suggested Melanie Perkins of Canva. And then finally, adaptability and the ability to learn very quickly, be very agile in how you learn. And it suggested Stuart Butterfield of Slack. So those were the 5 sort of top level traits that came back as what VCs mention most frequently as what really are indicative of a unicorn founder, but that those are, hard to spot.
Hmm.
Especially if you're talking about someone who's at an early stage, early in their career, and maybe, there aren't a lot of data points from what they've done to suggest that they really know that, there's no data points to suggest evidence of those kinds of traits. So I said, all right, let's look at well, what are the psychological or behavioral traits that you can assess? And I'm not gonna really I'm gonna give you, as I said, the link to the deck, and I'm gonna suggest that your readers or listeners go in and look at this presentation, because what was so cool about what came out from my conversation with ChatGPT is not only did it talk about the psychological and behavioral traits, but it also talked about the tools that exist today in the world of psychological and behavioral testing and interviewing that I've seen, and even we, as when I was working with 500 startups and some of the funds that I work with, have used to try and gauge whether these traits exist in and amongst founders as checks are being written. And it's a really interesting exercise for founders I've shared this deck with to think about, well, if I'm going to go raise money, have I prepared in such a fashion that I'm ready in case, some of these tools are used to assess me, whether they're interviews or they're actual diagnostic tools. And so I really want to encourage folks who are thinking about raising money from VCs to go look at that. I think it's really interesting. And then I, just kind of as a joke, I said, all right, well, what are the red flags that VCs most spot or most, frequently cite? And I played this game with the audience, which had a bunch of VCs in it, as well as a bunch of entrepreneurs. And I said, look, if you see something that you've said no to a deal because of, right? If you see one reason, and then I read through this list, then I want you to raise your hand. And every VC in the audience raised their hand on every single one of these things, right? And I'll read them out to you now, right? I'm looking at the deck, but if the team is imbalanced, what does that mean? Well, like they're all business people or all technical people. If there's frequent staff turnover, right? People come and they go quickly. It means there's something wrong with the company. If the founders, is an interesting one, if the founders lack self-awareness, right? This whole conversation you and I just had about, knowing yourself and knowing what motivates you and knowing, right? That's one that people have said, well, this founder, they didn't know anything about themselves. I passed on the deal. Every single VC in that audience has passed on a deal when the two founders or two of the founders were in a romantic relationship. Right? Every
Okay.
single VC is passed on a deal when they felt like there were too many projects that the entrepreneur was working on, even within the company, had too many products that they were working on, or they were doing product revenue and services revenue at the same time. So there's a difference between iterating product to try and find one thing that works and trying to diversify revenue too early. Then there was founders with narcissistic tendencies. And then the way that the chat interface framed it was bad crazy versus good crazy.
See, that's what I wanted to ask. Like, are there any founders that aren't narcissists? At least a little bit. Like, you have to have that
Well,
trait.
you've got to have look, most, not all, but most founders are trying to change the way that something works. I mean, the venture-backed founders, right? Ones that are trying to create unicorns or whatever. They're trying to change the way the world works. And they feel like they've got a way to do it. Hopefully, it's changed the way the world works for the better, not just change the way the world works to get rich. But change, right? Create some value in the world for a group of
Yeah,
people.
that'd be best.
And you do need a certain level of crazy to do that. You're indicating a different part of the research that I included in this presentation, which was about what is it that drives unicorn founders to succeed. And there was, a piece that part of the presentation included just highlights from research that a group called Defiance Venture Partners or Defiance Capital did last year. I think it was last year, where they looked at founders of every unicorn in US and Europe created between, I think it was 2003 to 2013. So it's a big data set. And it was only anecdotal, right? Because they couldn't interview every single one of them. But they did data on every one of them and have really interesting data that you should go look at. But there were three things. And one was that the founder had no plan B, right? It's not like they had a trust fund or it was going to be easy for them to go take take a job or something like that. It's like, burn the boats. I'm going to make this thing work. I'm going to run through brick walls to make my startup work. The second thing was that the founder had a real chip on their shoulder. There was something that they needed to prove themselves right. And that may be what you're thinking of when we're talking about that, at least hint of narcissism. And then the final thing was that they had unlimited self-belief that they could make it happen. And those were the key drivers of success as personality traits.
Yeah, and that's a very important attribute as well, like that belief. It can seem crazy from a side perspective, especially if you're not in the context of a given industry or of any given company, and you just see somebody who's trying to do something and you don't really understand what or why. And to face that criticism from all over, to hear from everybody around you that no, that will not work, and to believe that it will and convince others that it will. That's a very hard trait to
That's the
possess.
nuance between good crazy and bad crazy, I guess.
Indeed. That's the good crazy, because you gotta
That's
seem
the good.
crazy sometimes.
That's right. That's right.
Okay. Then, talking about those traits, I feel like there are still a couple we can talk about, namely failure and resilience. I feel like any entrepreneur goes hand in hand with failure, whether or not they want to. It's just part of the experience, I guess. And then the resilience part is a buzzword, I guess, in the VC world and generally speaking in the world today, I guess, as well. Everything is very volatile, very uncertain. Everything is hard to predict, and capital isn't what it used to be. It's not as easy to get capital as it used to be, and there aren't that, well, I don't want to say that many industries that haven't been disrupted, because there are always industries that can be disrupted and need to be disrupted. But a lot of people say that they cannot easily be disrupted by tech. That's basically we're entering a phase of standardization, commoditization, and there's just not that much space left. So let's talk about that. Maybe let's talk with resilience first. How do you feel?
Okay.
So what are your
Well,
thoughts on that?
again, it's goes going all three of those traits that I just talked about, right? The no plan B, the chip on the shoulder, the unlimited self-belief. To me, those all pack up into some form of resilience. I
Indeed.
think the thing that's missing there is, and this goes to the point that you made, and I agreed with on narcissism is, okay, well, now how do you channel that? And are you channeling it productively? Or are you channeling it destructively? What are you doing to um, maintain your sense of balance, your mindset, your health, your family, right? What's your process? What's your ritual? Whatever you want to say, um, that keeps you going. But look, changing the world, and it's certainly not only founders that have to do this. Right? There's plenty of other people that have to work in very difficult environments, with lots of things that they cannot control. But to me, resilience is the number one thing that founders need. I've got a friend, a woman that I worked with as a colleague at 500 Startups. She now runs a fund that's based in San Francisco called Cake Ventures. Her name's Monique Woodard, and she has a question she asks herself when she's looking at a founding team, um, and she says, "All right, when things get tough, right? It's an exercise that she does silently, but when things get tough, which of these founders may not make it? May you know pull the ripcord and leave, um, because they don't have the resilience to make it through. And then can the company still make it without that individual or those individuals? Because no matter how good a startup may read after the fact, right? When you read about it in TechCrunch or Sifted or whatever after it's done this. It was hard. It was like this on the way to getting there, and so it's really difficult. It's interesting. One of the, if not the best performing venture fund in Europe, it's called Hummingbird Ventures,
Mhm.
and their thesis is to invest only in founders that are neurodiverse or trauma survivors,
Hmm.
because they believe that is indicative of seeing the world differently and having resilience, right? If you came from a war-torn region, you pulled yourself up by your bootstraps from a refugee camp, whatever, you'd have to go. There's lots of work written about their thesis that you can search for online. But that folks who have been through a very hard time, or are neurodivergent, they have, if they've made it to the point of starting a company, they've got some internal resiliency resources that give them an advantage when you think about the toughness of building a business.
It's something that I haven't directly considered, but very hard to disagree. Like, yeah, people who face challenges that most are unaware of throughout their lives from the very, very beginning, and then they arrive to a situation where they positively face the challenge of becoming an entrepreneur, something that isn't safe by its very definition, where they undertake that risk, then that is already a guarantee of their own, and of the good crazy, I guess,
Yeah,
that they at least believe in themselves and they have the data to prove it because they have survived hardship and they have the skills necessary to do it. And it's very, very cool thought. Very cool thought. I was not
yeah.
aware of that thesis, to
And
be honest, but
when you look at the results of this fund, very impressive.
indeed, indeed, indeed.
Yeah.
That's very cool. So then that leaves failure. I guess that goes without saying, right? Failure always exists, and you have to learn from it, and you have to work with it. And following narcissistic traits, it's not always as easy to accept your own failures, and I think that's important. Maybe you have some particular examples that come to mind where learning from failure became very, very
Endless,
critical.
endless, endless. Um, all I can say is I'm really grateful to have had so much of my career in Silicon Valley, where whether it was embraces failure or has an economic model that allows for it. It's been a real privilege uh, to have so much of my education, practical education, paid for in that fashion. picking picking just one mistake to talk about would be very difficult. Um, it would be very difficult.
Okay, I won't pressure you to
Uh,
go deep into the failures.
well, I'll give you one. Right.
Okay,
I'll give you one. So I'm one of those people who, even to this day, is still deathly afraid of public speaking. Right.
that
But I
does not
do.
show.
I do well. It's because I mentioned that I went through this process of through taking a company public, right? And I was right. My little startup was acquired, and I was a senior executive going through the process of the IPO. And when it came to the first meeting, it's called an organizational meeting with all the lawyers and investment bankers and all of that. I was senior, young, uh, late 20s, I think, and I had a team. I was appointed the head of product of technology of this company, and
Mhm.
had a whole bunch of much older engineers and product people and whatever working for me. And then I'm in front of all of these investment bankers. Never been in an executive meeting of this scale ever. Um, and I just froze. I just froze, and mercifully, the other executives at the company were able to support support me through that process. But that was, I obviously walked out of there feeling like I had let everyone down, um, and so that started a journey for me where I, to this day, do everything I can on an ongoing basis to try and improve my ability to communicate in front of large audiences. Right. So that was the personal failure and what came out of it. Um, and I would say this goes back, and this is sort of a pivot, especially, and I think this is important, um, particularly for your audience who are in a corporate environment where failure is a lot less tolerated than in a startup environment, or in an institutional environment. Um, because I hosted, in working with all the bankers through Swift, in being, a fintech guy in Silicon Valley that would host endless numbers of banks and central banks and things like that, who would come to visit and see, how does Silicon Valley work and fintech work, and doing all the speaking, and then engaging with lots of corporates. Um, I learned um, a different phrase, which is, it's not about failing or failing fast. It's about experimenting cheap. It's about, right? If you as an individual, if you as a company, if you as a corporation learn faster and cheaper than the other guys, the chances are you're going to win.
Yeah, that's true.
Right.
That's true.
Fast you can't change the pace at which the market's gonna change, right? The world around us is gonna change. So the question is, how fast and cheap can you learn?
It's a great way of putting it, because I feel like the younger founders, the younger entrepreneurs always try to find the best solution, the best way to move forward, build the best team, build the best product, release to the best market, have the best client. But it never turns out that way, because that probably does not even exist. What is the best team? The one that does its job within the confines of reality that they exist within. But what truly makes a difference is learning from your mistakes. And then, like you mentioned, the speed and the cost of those mistakes. If you minimize those, maximize the speed and minimize the cost, then you become just faster than everybody else. And yeah, that's true. Completely true in my experience as well.
Right.
Very,
So
very
when I would talk to large, when I even to this day, when I talk to large, you know, institutions, the capabilities that I talk to them about, the cultural transformation that what they need to invest in their people, in their systems, is about for learning, for innovating, right? Is about, do you have the capacity to experiment cheap, to surface new insights, new data, new proof about the world faster and cheaper than the other guys?
true. True. Completely true. In our company, when we run things, we always think of, okay, what percentage of our revenue are we willing to spend to experiment, basically to fail, and what amount of experiments are we willing to do, and what is the outcome of those experiments, and how do we move forward from them? It's just a constant thing that always needs to happen. Naturally, some additional failure will happen to you along the way, but when putting yourself out there, like with your example with public speaking, when you understand and when you feel that, okay, there is an impact if I develop that skill set, for example, or if I learn from that particular mistake in my past, then you just know where to focus on. It just makes sense. If you don't, then the world is your oyster. You don't really know where to go and what to do, and it just becomes overwhelming very quickly.
Yep.
Okay, let's then talk about the industry itself. We've talked about fintech for briefly in passing, so to speak. From your experience looking at the industry evolve from its very, very infancy to a juggernaut being today, where every single system is either connected to a technology or being driven by technology or just basically is a technology in finance. What are the top key developments, challenges that the industry is going to face in the next 5 years, for example?
Well, I would take a little bit of an issue with how you characterized it, and here's the reason why. And again, this is another thing. I give a regular talk about this, and I'm going to give
Yeah.
you a link you can share with folks that they can look at this deck that I update somewhat frequently. So in 2021, the global financial services industry represented about $12.5 trillion of market cap. Right?
Yeah.
Think about this. Only about 2% of that was fintech.
Indeed.
By 2030, the financial services industry will be about 22 trillion in market cap. And only about 7% of that will be fintech. So we've got a long, long way to go before financial services are truly infused fully by technology or by modern technology, right? All financial services have well, not all, but a lot of financial services globally have a lot of technology. A lot of that technology that's there today is 40 or 50 years old.
Oh, yeah.
Right?
Yeah.
Right? I'm sure you guys have clients that look like that.
Indeed. very familiar with how that stuff works. Yeah.
Right. But so we've got a long way to go. The next thing to think about is that financial services is pretty much the most profitable industry on the planet with 18% gross margins. That means that, roughly today, there's 2.3 trillion in profit for entrepreneurs to go after.
That already sounds very tasty.
Fintech is nowhere near done. Right? Okay. So if that,
you know what, I accept that criticism. I agree. Yeah, that's definitely a mischaracterization of what fintech
now,
is.
what does feel for the moment as kind of done, and I'll reverse this in a moment, but what feels like it's kind of done is the easy stuff. Retail and small business savings accounts, sending money with things like Revolut and Wise, and because that stuff in the grand scheme of financial services, that stuff is actually pretty easy when you compare it to things like corporate finance and how capital markets work and wealth management and emerging markets finance and insurance. In the big scheme of things, right? Again, only 2% in 2021 of this monstrous industry was really touched by fintech. So we're nowhere, right? And that's the easy stuff. And we're going to get, the IPO window is going to open up, and there's a couple companies that are going to, you got like Nubank in Brazil, and Chime is going to go public in the US probably, and so there's some more, but we got a lot in how the guts and the big money in the financial services industry works still to go. Okay. So if the markets that need help are things like corporate finance and capital markets and wealth management and emerging, underserved markets in emerging markets and insurance, then you've got technologies that are maturing to help. And those are things like AI and embedded finance, and finally, maybe a real regulation infrastructure, global regulation understanding of what do you do about tokenization. In my fintech deck, one of the graphs that I point out, if I just want to talk about AI, one of the graphs that I point to is something that I think the research was found by Bank of America, but there are others out there that do it. And what they found was that over the last 20 years, before the sort of growing popularity of like ChatGPT and the tools that end users are using now, what you saw for productivity amongst S&P 500 companies was that in the last 20 years, the number of S&P 500 employees required to generate $1 million in revenue went from about 9 people down to a little more than 1 person. And that's before all of these AI tools. So when you think about how many people are employed inside large financial institutions around the world, and you think about how much more productive these new AI tools may make those firms, you begin to get an idea of what might happen.
Yeah, that makes sense.
Just with AI, right? If you want to think about tokenization, and I'm going to take speculative crypto and push it all the way to the side, right? I'm not talking about meme coins and all of that, but I will consider, real world assets and tokenizing those and making it more efficient. Today, there's 475, maybe a bit more, $1 trillion in real world assets on the planet, right? Buildings and et cetera. And pretty much all of that is managed on paper and PDFs. So what happens when you digitize all of that and then automate the way that you manage it? How much more efficient does it become? And what happens now if you could, slice and dice those assets in such tiny little pieces that you can make them available to individuals in sub-Saharan Africa to invest in, where like they could buy a fractional share of Apple Computer, or they can buy a fractional share of an office building in London that is generating real money for real rent for real, right? That
Yeah.
becomes really interesting. Forget about crypto, wrap it in, the bright light of real regulation, which hopefully will be implemented with modern tools that is more about, that brings much more efficiency than what we have today. That gets to be very interesting. Or, one of the areas I'm very passionate about is the idea of embedded finance, which is, I'm really interested in terms of the driving growth in particularly emerging markets. I don't think you get a lot of growth in emerging markets, and this is going to be challenging to some people, from putting more venture capital to work in emerging markets. I think you have to put more debt to work in emerging markets. But today, if you get, the World Bank or the IFC or Goldman Sachs or whoever, they can only operate with debt in giant chunks, right? In billions of dollars at a time, because of the cost of underwriting and the profitability that they're trying to drive and these kinds of things. Well, I've got one company I advise. What they do is they provide loans to smart asset entrepreneurs. And you might say, well, what is a smart asset? A smart asset is a physical device that has a chip, like a motorcycle taxi or a blood testing machine or a water purification machine. And those devices cost money, but they generate assets, right? They generate, income as they're used. And if you can give someone in Kenya or Nigeria or South Africa or whatever a loan on an automated basis to finance at a reasonable rate of interest a motorcycle taxi or a couple of motorcycle taxis, cheaper than a bank can, because you've used technology to see where more motorcycle taxis are needed, right? You put in a shut off, switch in the chip, so the motorcycle taxi becomes a brick if the payment isn't made. Then what are you doing? You're enabling more people to become not venture backable entrepreneurs, but entrepreneurs that can generate real income to support their families, to support their communities. But the only way that you can do that is if you embed lending into the operations of the network of motorcycle taxis or fast moving consumer good delivery networks, or the list goes on and on and on. So when you think about delivering financial services at points of points of operation or points of sale at sub, bank loan size, sub credit card size sizes. That has an enormous impact, enormous potential for growth, enormous potential to drive economies for the better. Super exciting.
But it requires a lot of investment, a lot of regulation, a lot of people to be, well, good crazy about implementing a whole bunch of different systems that need to overlap and work with each other, and then on top of that need to be regulated. No easy task, it sounds to me.
No, but as you said, good crazy. Right. I mean, one of the coaching programs that I'm working on, right? I'm just in the process of launching a coaching program designed for venture-backed founders, particularly outside of Silicon Valley, to help them learn some of the things that I've learned over the years, and many Silicon Valley entrepreneurs know about raising capital. And I'm working now with a couple of colleagues on a similar program for debt entrepreneurs, right? Folks that are working on lending businesses or trying to breach into embedded lending businesses to help them deal with some of the challenges that you're talking about.
So we'll be keeping an eye on the graduates of that course to be the next people to build unicorns in the evolving markets.
Let's hope.
Let's hope. And if you sound interested in that, go and find Mike. If there's places still available, I think you will benefit from it very, very much.
Thank you.
So before we wrap up, we've talked a lot about what constitutes a good founder and how VCs look at founders and what do they look for. And you've mentioned briefly corporate VCs as well. So maybe we can give some advice to corporate VCs as to what they need to look out for and what their perspective is like when looking at the market, at the founders, and at potentially next unicorns.
Wow. So it sort of depends how you want to address that question. It could be, what do you need to think about if you're looking at becoming a corporate VC, or the question is, how do you find startups that you want to work with, and how do you be a good citizen when trying to work with them, and then how do you bring the innovation back into the company? And the questions are related. But they're not mutually exclusive, sorry, they're not a direct overlap. And what I'll say is there's something to think about here, and it goes back to what we were talking about very early on in the conversation. Remember that when it comes to startups, when it comes to unicorns, we were talking about timelines of 7 to 10 years. The average corporation operates on annual or quarterly timelines. And that timeline mismatch, I've found, is the number one thing that causes difficulties when corporations and startups try and do things together, regardless of whether the corporates are trying to buy from, learn from, invest in, whatever it is from startups. And it's strange because there's two sides to it, right? A startup says, "Oh, well, I can code this thing really, really fast, and I can pitch it to you really, really fast." But especially if you're a startup that's right, and I'm sure you guys run into this all the time, a corporate decision cycle to make a major technology investment may take 18 months to make an investment, another 18 months to do procurement, and then another 18 months to do deployment. And just in the first 18 months, a startup can die for not having enough money.
True.
By the same token, if you are a corporation who's trying to make an investment in a startup, you're expecting to see a return on an investment in a couple of quarters or a year, whereas a private company, early stage startup, won't generally generate liquidity for 7 to 10 years. So that impedance mismatch, or that series of impedance mismatches, means that this stuff can't be taken lightly on either side of the equation.
Yeah, that makes sense. That makes sense. Like the corporate approach is more predictable, more transparent in its essence. Would you say that that mindset contributes to well, the kind of the heightened expectations of startups? Like overall, from what I see at least, is that more and more the expectation for startups is to at least showcase a functioning business model instead of just a great idea and a great niche or a great technology. Where, okay, that sounds wonderful and wonderful once more, but show me the money. Show me how many customers you have. What's your customer acquisition cost? What's the lifetime value of a customer? And more I see that that's just the basement, that's just the entry point. And then once you go into the details, that's where the deals are made. Or is that just a very skewed view of somebody very, very far away from Silicon Valley?
Well, geographically, you and I are now closer than right to each other than either of us are to Silicon Valley. But
That's true.
you're at least now. You're you're touching on something that we didn't address, but your question said we might, which
Mm.
is sort of the cyclical nature of the venture industry, right? Remember that a couple of years ago, we were in an era where interest rates were very low, where it was very easy to raise for venture funds to raise capital, and that as a result of that, for startups to raise capital, and that's pretty much everywhere in the world. And when there's all that money sloshing around the market, then it just makes economic sense for funds to or investors to have options on smart entrepreneurs, which means, with a good idea and a reasonable team, I should go ahead and write a check. Hopefully, I'm going to write a check that isn't at a silly valuation, but I'm going to write the check because it's better for me to be in a likely good deal or a potentially good deal than have missed it to a competitor. But then interest rates skyrocketed. The last couple of years have been horrible for VCs for raising new funds. Lots of VCs are going out of business. More will go out of business. There will be many more markdowns, I think, in this next year. And so what does that mean? That means that at any given stage in the journey from idea to IPO, the bar of what you have to accomplish to get a certain amount of capital to continue on the next step of the journey is gone up.
Mm.
Right?
Yeah.
So, and it goes in cycles. I think there's a really interesting thing that exacerbates it to a degree, but it's even more interesting as a feature of how the venture industry is going through its own disruption right now. Possibly. No, I'm not sure. Possibly it's worth using the word disruption. Not sure, but it's definitely going through a transition.
Mm.
And I want you to think about it this way. When we, as an industry, moved from Web 1.0 to Web 2.0, what really happened, right, for startups, right, was that you compressed the cost of finding product market fit, right? You needed a lot less capital because you didn't have to buy servers. You didn't have to buy your own internet connections. You didn't have to buy as many billboards to try and get users, right? You could buy ads on Facebook or Google, right? Because now all of a sudden you had social networks. And that was, sort of the 2008 timeframe, right? And and in venture, you also had the growth of things like crowdfunding, and you had AngelList, and you had SPVs, because the cost of proving that an idea was valid was went from a couple of million to maybe a couple 100,000, right?
Maybe.
And then once you prove that, then it was, especially in Silicon Valley, but you can think about this globally, then you had to go hire lots of really expensive engineers and salespeople and marketing people and bid against competitors who were also well funded for keywords and all of that. So you had the growth of these mega funds like Andreessen Horowitz and Sequoia and Balderton and all of that. And so you got these giant venture rounds. Right? So that was what happened in the move from Web 1.0 to Web 2.0. And then all the way at the end of the chain, you had, right, sort of the natural consequence of all of that, more and more companies coming into the technology industry, more and more companies buying ads, more and more companies buying cloud compute. So the valuations of Amazon and Google and Salesforce and everything else were going up, which led folks to believe that some of these companies that were at the early stage that didn't cost that much in order to prove out, but then they would raise a lot, would ultimately exit like decacorns, right? So there was this that's what happened. All right. Now, with AI, what are we beginning to see happen?
Tell us.
Right? What we're beginning to see happen is that little group that gets together and starts with an idea, and maybe it will be that when you have one person who learns how to build agents, it will be one person. But now all of a sudden, you don't need all of those salespeople and coders after you prove product market fit and positive unit economics. You can have agents doing it for you to scale. Maybe, right? We've just learned some new things recently about the actual profitability of OpenAI, that their $200 a month product is not profitable because people are using it so much more. So has yet to be seen, right?
Indeed.
But the point is that just like those banks we talked about earlier that are going to, right, and large S&P 500 companies that should see more and more productivity, meaning they need less and less people to generate $1 million, or that they should, you should cross the asymptote and you should see multiple millions per employee instead of, a fraction of a person to you get the idea. With startups, as we're going from a Web 2.0 era to a AI as a platform era, we don't know yet. Will we need mega funding to build companies after seed, after Series A? What's going to happen? Because again, at Web 2 era, we needed lots and lots of money to hire lots and lots of engineers and salespeople and spend on marketing. But now if AI is going to be able to do all that for you, do you need lots and lots of money or not?
That's the question.
It may be a big, big shift in what the economics of the venture capital industry look like.
True.
And that,
True.
right? So if you're a startup, and I can tell you, it's not quite at the point of deal killer yet, but I can probably tell you that if you're almost any kind of startup and you haven't figured out from early days how you're going to use AI tools to learn fast and cheap, to be more agile and have a lower burn rate than the other guys, you probably won't get funded.
Which is very hard to do with AI tools by definition because it's emerging tech and people don't know the limits of them, and applications for them are being come up with every single day. So, but I agree that you do need to do it still.
And I would tend
Okay.
to say that the same thing probably applies to, or it will begin applying, I think, to companies, traditional companies, SMEs. Again, investors are going to begin to ask questions about, and it's more than what's your AI strategy. It's why here's a great example. Klarna is now, pretty famous for saying they trained an AI bot that handles the customer support work of over 700 people with higher NPS scores. So if you are an SME and you don't give better, faster experiences by using these tools, what are your investors going to think?
That's the question. That's the question. And I feel like a lot of SMEs are banking on, or rather betting without banking just yet, on the closeness of the human touch. Like, I feel that there's a counter movement to a lot of the digital space and digital presence and AI in general, where people try to be a bit closer to each other, I guess, if that does not sound too, I don't know, romantic.
No. That I agree, but again, that may end up being a completely different positioning
Yeah.
than what you have,
Different
right?
business
It's like,
model.
exactly. I mean, do I agree that that human touch is something that people will prize in many situations? Yes. Is it the model that you've been operating on previously?
Mm.
Who knows?
Yeah, yeah. Interesting future, definitely. Some
Super fun
things
stuff.
will change. A lot of them will change. How specifically? Very, very hard to predict. But exciting to be here at the end of the day.
Got to be in the game.
Yeah. Yeah. Thank you. Thank you, Mike. And thank you all as well for joining in and listening to us talk today. As we've mentioned, as Mike mentions, he has gracefully shared some content with us, and decks that he has mentioned throughout our talk will be down in the description with the links. If you don't find them there, you can find Mike on the internets. I think, what's the best place to find you, Mike?
Sigal, Sigal, ventures.com. That'll point you at my bio. That'll point you at my services. That'll point you at all of my content. It'll point you at my new Pitch Slap Venture Academy, which is the training program for entrepreneurs to turn great entrepreneurs into unstoppable fundraisers. SigalVentures.com. Thanks so much
SigalVentures.com.
for giving me the opportunity to talk with you and talk.
And thanks for joining. And like, share, and subscribe our video here on YouTube, or if you're listening to us on Spotify or Apple Podcasts, like, share, and subscribe to that one as well. And as always, look forward to the next one, and bye-bye.